Okay. Good morning, ladies and gentlemen. It's a great pleasure to be here today and have the opportunity to share a few thoughts on a topic that will not only dominate the political agenda of the current legislative period, but significantly alter the regulatory environment in which market participants and market infrastructure providers act. What started as a buzzword on the political agenda in mid-July 2014 has now, only half a year later, turned into a conceptual framework that we're discussing today. From a Deutsche Börse Group perspective, one of the main objectives of the CMU debate is the efficient capital allocation throughout the EU by developing non-bank sources of funding in order to ensure what we've heard today, growth and job creation. As a neutral market infrastructure provider, we support this approach since we consider ourselves predestined and well-positioned to contribute to this dialogue. In light of this general assessment, we have started to develop principles we deem necessary for a functioning capital markets union, basically at the same time as the EU Commission did. In this process, we have identified 6 core principles as respective prerequisites that demonstrate a considerable match with those outlined by the EU. Namely, these are: rebuilding of investor trust as part of an effective level of consumer and investor protection, improvement of non-bank funding in order to maximize the benefits of capital markets growth and jobs, promotion of financial stability by means of a single rule book for financial services, facilitation of harmonization and removal of barriers in order to create a single market for all 28 member states, shaping the supporting regulatory and supervisory environment to attract investments from all over the world and enhance European competitiveness, and an additional one, which is the overall increase of transparency, which we have discussed in the panel this morning, how important transparency in general is. Regarding the actual development of these principles, it will be crucial to move the pendulum towards more market orientation, bringing existing regulatory aspects and identified gaps together to establish a real capital culture, harmonize fragmented markets, develop alternative financing options, and reconcile existing capital market regulation. For timing reasons, I will only elaborate on 3 of the 6 principles, which are investor trust, non-bank funding, and transparency. But we have to keep in mind that for the purpose of a functioning CMU, these 6 core principles have to be seen as an undividable set. And this is basically shown when you look at the first 2 principles that I will shortly elaborate on. As a result of the global financial crisis, confidence in financial markets has decreased dramatically. The lack of trust in the banking system, combined with a lack of financial understanding, has developed into a lack of trust in capital markets as a whole. So, consequently, one of the most pressing basics regarding capital markets in general and the objective of substantially reforming non-bank funding is the necessity to revive investor trust. This holds true for companies as well as investors in order to restore the demand for new sources of funding. Measures in this space include, communication-wise, a promotion of the use of fair, efficient, and transparent markets that operate under highest possible standards, and education-wise, the advocating of initiatives aiming at giving the wider public a greater understanding of the functioning of capital markets and the benefits of attractive economics which can be achieved through non-bank financing. we have heard that today already, European markets have reached a crossroad. As opposed to the US, the European system relies heavily on bank funding, while in the US, only 30% of general financing needs are covered by bank loans and 70% via capital markets. It is exactly the other way around in Europe. In the wake of the crisis, intensified banking regulation has forced banks to strengthen their balance sheets, and as an effect, bank funding has been decreasing in response to higher capital and liquidity requirements. So what now? Now, the EU needs to attract companies of varying sizes to enter into equity and debt financing via primary markets, while improving their access to liquidity through secondary markets as an additional financing channel. Besides funding, companies require capital markets also for hedging and minimizing the risks that arise from price fluctuations. To be really clear at this point, the Capital Markets Union is obviously not to be understood as anti-banking. It rather defines a new role for banks as an essential pillar to support the striving for growth in Europe while guaranteeing the highest level of consumer protection. However, I do believe that a recalibration of the ratio of bank funding versus non-bank funding has to take place. So ideally, both bank funding and non-bank funding exist in parallel, giving companies a range of choices how to finance their necessary investments. Since SMEs, and we have talked quite a bit already this morning about this interesting animal, to put it that way, since these SMEs play a special or central role in terms of economic activity and employment in Europe, market infrastructures should be used to fill the existing transparency and efficiency gap between all relevant constituencies in the IPO setup phase, so before the IPO. Deutsche Börse Group, for example, is currently developing a pre-IPO information and brokerage platform connecting SMEs and investors, a concept envisaged as something similar to a short window display set to be launched this summer. I have mentioned the factor transparency a couple of times already. Transparency improves the quality of price discovery and reduces investment risk. Price transparency across all asset classes is crucial for investors in a stable financial market, while, on the other hand, supervisors even need additional data to be able to spot potential market risk. Yet in reality, transparency is a demand of a general public rather than of individual market participants, who prefer not to risk their information advantage by disclosing trading data. And the rise of the OTC instruments and the OTC trading is a sure indication of that fact. However, a lack of transparency can cause a serious threat to market stability, especially during stressed periods, as seen in the recent crisis. The Capital Markets Union should therefore look to improve upon existing initiatives, ensuring transparency for functioning price discovery mechanisms, while keeping in mind that different data users, like retail investors, institutional investors, and supervisors, have different transparency needs. Hence, data provision to cater for transparency needs should only be required where it is necessary to avoid additional costs for investors and supervisors. Finally, let me briefly touch upon a thought, the necessity of harmonization. The Capital Markets Union is likely to be a good vehicle through which to dismantle some of the cross-border barriers that we have discussed this morning, preventing the development of integrated capital markets. Regulatory initiatives, and this is something we have to keep in mind, that were recently developed or reviewed already follow the concept of harmonization. Yet significant fragmentation still exists in the public domain. And we have heard what it is. It's securities law, it's insolvency law, it's standards for SMEs, it's tax procedures. So there's quite a long list of topics that you could work on. And I know, and I've seen the faces in this room, I know that these are really ambitious projects. But I also believe that they could add great value. So it's nevertheless something that we really have to dig into and look at. Summing up, I think the Capital Markets Union is a unique opportunity for all interested stakeholders, and in particular market infrastructure providers, to shape the overall political agenda in its shift from crisis solving towards meaningful growth. A functioning CMU should reconcile loose ends with regard to finalization and implementation of existing regulatory initiatives, and additionally, it has to limit the regulatory burden to what is essential in order to create conditions that guarantee an attractive environment for companies and investors, that facilitate an efficient supervisory structure, ultimately ensuring European competitiveness in truly globalized capital markets. We are looking forward to discussing a wide range of next steps in developing a CMU in Europe. And in its green paper, as we have heard by Philippe, we have seen short and long-term measures for all principles, referencing also regulatory initiatives that are already in place. We have to keep in mind the combined aim is to deepen existing markets and develop non-bank funding sources to allow the free flow of capital across all 28 member states. To realize a broad capital markets union, it will be important in the upcoming months to bring the views of all interested stakeholders together and to discuss their ideas. Thank you.